This is where people piled in saying they have orders standing, saying buy gold if it breaks to new highs. And everyone piled in. And as soon as that wave, that technical level of emotions of everyone doing the same thing is finished its momentum, it goes back in the opposite direction. So literally it gets you out of a potential winning trade if gold is going down. The shorts are now out. And then anybody who just bought is now instantly taking a pretty big loss. This is a 5, almost 6% pullback in gold.
The Financial Survival Network. Now more than ever.
And welcome. You are watching and listening to the Financial Survival Network. I'm your host, Kerry Lutz. Well, Chris Vermeulen is with us now. You know him well, thetechnicaltraders.com. Any questions, comments, shoot me an email, kl@kerrylutz.com. Chris, been wanting to get you on the show for a while. In light of the resurgent stock market, which maybe is cooling off a bit now, resurgent gold prices, what's doing with the bond market, and all of that good stuff. It's great to have you back on. So first, stock market rally out of nowhere, huh?
Yeah, no kidding. I think a lot of people probably weren't expecting it. Although, I mean, really, in the grand scheme of things, if you follow the charts and you even look at seasonality wise, I mean, it is a pretty clear chart setup that we have going into the holiday season. So let me share my charts and show you something really interesting when it comes to the stock market rally. Let's go to the daily chart of the S&P 500. And what's really interesting here, if I look here, and this is just this year's price action. So the market went up, topped out in June, July, and then pulled back to the end of October. And now we've got this kind of holiday rally bounce. And, people were very nervous. We saw huge panic selling down in this phase here. Yet if we go and we take a look at the seasonality charts for the S&P 500, it is almost the same price action. We see it work its way up into June, July. It pulls back to the end of October. And then we go into a multi-wave rally, the holiday or Christmas rally, into the end of the year. So this year has moved pretty much identical to how it has over the past 30 years, which is pretty interesting. And right now we're seeing the stock market have a little bit of a pullback this week. It's hit resistance levels, the S&P 500, but seasonality wise, it says, hey, we're probably going to see this market naturally pause or pull back for a week or two. And then we go for one final push up into New Year's. So that's kind of a view that I see on the market, hopefully unfolding. And the exciting part is going to be is if this stock market gets traction, we are in striking distance on the S&P 500 of coming back up to hit all-time highs. I mean, we're really only 4, 5, 6 big days away from all-time highs. And that is going to spark some pretty interesting price action, which when you and I touch gold, people will be able to see a visual. But when we hit new all-time highs, if we do, anybody who is short the stock market, betting on lower pricing is going to want to cover their short position. Bail. And we're going to see a huge short squeeze. Volume will spike. There'll be a sharp pop in price. And then there's also going to be another camp of people saying, well, I missed the whole rally in 2023, and now we're hitting new all-time highs. It's going to be headline news, stock market, new highs, new bull market in place. And so people are going to pile in and buy. And we'll see this really good on the gold chart in a minute, but what happens after that technical breakout and short squeeze and kind of fury of people chasing and trying to get into the market is going to be really interesting. This could be a major double top in the stock market after this kind of wave kind of fizzles out. And we poke to nominal new highs. So I'll show you on the gold chart in a minute here, but of what I think it could happen. But it is pretty exciting. I think we're still in line for higher prices going into the end of the year. And, we're really seeing, definitely seeing a battle between which stocks are rallying. Like, for example, yesterday, the large caps, which is the fourth, large cap stocks were down, all negative, but the Russell 2000 rallied dramatically. Today, the large caps are up and the Russell 2000 is down. So there's definitely the big tech still and the big caps are kind of driving this market, but there's definitely a disconnect between money flowing in the big caps or into the small caps. It's kind of one or the other at this point.
Yeah, really interesting. It just came out of nowhere, shocked everybody. And, but the volume spikes just aren't there, are they?
Well, you don't need volume for higher pricing. Low volume typically favors higher pricing. Typically, if you get high volume, that is usually actually more to the sell side. It's just there's natural inflow of money into the stock market from people's paychecks and all kinds of different things. There's just natural kind of monthly and quarterly inflows. So the market naturally wants to go up even without big volume. And for the markets to go down, you technically need extra volume. You need more volume than a natural inflow for the day to drive the price down. So that's why you typically see down volume days are higher volume if you look at the red spikes on the charts. I wouldn't ever gauge a move by the volume. You do not need big volume to go in. And typically, if there's huge volume, it actually becomes a crowded trade, and it usually becomes a standout high or a bottom in a market, which if we transition over to gold, we can actually show that really well.
Okay, cool. So we're going to just see more of the same as what you're saying. And I tend to agree with that because a trend in motion remains in motion, right? The trend is your friend until the end.
Yeah.
Hey, God, look at that chart, man. That chart is, and then just looking at the lows, 1840, and below there, that's an unbelievable chart.
Yeah. So we saw this big move up there a day ago, and then we've seen it get crashed down on some really big volume. And let's step back for a second. Let's look at the monthly chart, because this is a really good gauge of what's going on. So more or less, we came up and we broke this wick high. Whoops, sorry, wrong line. We broke that high, and this is the level that if somebody is short the gold, betting on lower pricing, then they're going to want to cover their shorts. So there's going to be a big wave of buying. There's also going to be a ton of people saying when gold hits new highs, I'm buying it. Right. And so we broke that level. Now, if we look at it from a 10-minute chart of what happened, this is more or less where the price broke out. And you can see the big volume. This is where all the shorts covered. This is where people piled in saying they have orders standing, saying buy gold if it breaks to new highs. And everyone piled in. And as soon as that wave, that technical level of emotions of everyone doing the same thing is finished its momentum, it goes back in the opposite direction. So literally it gets you out of a potential winning trade if gold is going down. The shorts are now out. And then anybody who just bought is now instantly taking a pretty big loss. This is almost 6% pullback in gold in really a day and a half, which for gold is a massive move. A big day on gold is usually 1%. 1.5% is a pretty big day. So this is what could happen with the SP 500 when it pokes to new highs. We're going to see a huge amount of people covering their shorts. We're going to see new people pile in. It's going to be mainstream media, just like what we're seeing here right now in gold. And the same thing could happen if big money steps in and just starts unloading into the stock market. Because I do think some of the big money players, they do see, I think, dark times ahead. I think think the market is going to try to get to new all-time highs so that it can unload. The big money can start getting out, and they can start distributing and getting out of their shares, because the big funds, they take months to roll out of positions. They can't just unload. So the market likes to try and hit these nominal new highs and get people sucked in and create buying pressure, buying demand, so they can unload into it. Just like gold. This was like literally a technical play. And if we zoom out a little bit here, this is the 10-minute chart, and we can see how this goes back several days, but the volume in the past 36 hours dwarfs all of that of the normal.
Look at that.
Trading sessions. So it's definitely like a crowded play. If everyone's doing it and it's mainstream, it's usually a major turning point. And to take it one notch further, let's actually just take a look at the monthly chart. And if we look at this monthly chart, this is a very bearish candle, a candle that rallies up and then gets slammed down and closes near the low. We've seen this previous times. Whenever there's a long upper wick and it gets rejected, the average pullback for gold each of these years is about 17%. So there's a lot of potential downside for gold here when we look at this futures chart. And the other interesting thing is, let's look at GLD, which is regular trading hours. This is where the majority of volume trades. This is the monthly chart. And if you notice, and I
For
draw
people
the
who
highs,
for people who think they're trading gold, right?
yeah, during regular trading hours, it has not even broken out yet, and so it is still lingering in in the range, well within the range. So the fact that gold did all this stuff and silver barely budged, gold miners barely even budged. In fact, they're all selling
The
off and moving
miners.
lower. There's no real commitment behind this. I feel like it was a technical move. The market was just, I think it saw a lot of positions it wanted to really shake up and try and just get people whipsawed out of positions. But so I don't believe this gold move yet. It's exciting, but I don't believe in it.
Same here. Although I think it's paving the way for the future.
For sure.
I don't think it is the move, but higher highs, higher lows, right?
Yeah, it's working its way through this pattern, but there definitely was like a little fake out, I think, at this point, that whole move yesterday.
Yeah, it could well go down. How much lower it's going to go? It did. Let's not forget, Chris, it closed the month over 2,000.
Yep.
First ever, right?
Yep.
So I find it pretty fascinating to watch, but I don't think we're quite there yet. But I've been wrong before many a time. So that would be interesting.
Yeah, and we saw the gold market pull back a bit, and this is the monthly chart. I'm actually just going to go to the daily chart real quick here. So we have seen gold. It rallied out of October, pulled back in November, and now it's rallying up into December. If we take a look at the seasonality chart of gold, of how it typically moves, we see the rally up. It pulls back a bit, November, beginning of December. And so, we might see gold, hold its ground and try and push a little bit higher or hold the level it's at. So there's going to be a bit of a positive bias here, I think, for gold. It really just had a big blow off top. It's pulling back a bit. So I think we might see gold hold its ground and potentially trade. This is the daily chart. It might actually trade its ground and build a little bull flag right under this all-time high. And it could actually become a bullish pattern and continue to take off. But just this one-day whipsaw is more of a technical, a flood of orders and automated triggers happening. And so you kind of have to negate that. You have to try to erase that out of your brain and be like, okay, it did happen, but to me, it was more of computers and automated trades running a very thinly traded market. And that's why you get these big whipsaws. So I think we might see a bull flag pattern, and maybe gold is going to continue to push and rally and become a bit more of a defensive play and start to hold new all-time highs. So there's still a bullish case for it. It's just right now it's definitely a little shakeup.
And Q1 is always generally pretty strong for, it's the midway through Q4 going into midway through Q1 roughly, right?
Yeah, gold does typically fairly well, really, from October into the end of February. So it still has a few months of upward bias.
Yep. All right. So what's next here?
We could take a quick look at the dollar, because they're very, very much related. So we have been seeing the dollar. This is the daily chart. Dollar's been moving down over the past, really since the stock market bottomed. Typically what we have been seeing, especially when there's a lot of fear in the market or strong waves of fear or greed, the dollar tends to go the opposite as the stock market. So the stock market has rallied, the dollar has gone down. That has also helped move gold up over the past month and a half. And then, of course, we also had gold the dollar put in a big pop. And that's put a little bit of pressure on gold in the past 2 sessions. And I do think we're probably going to see the dollar flounder and potentially work itself lower as we go into the end of the year. I think stocks are going to still become the favored play. There's going to be probably a lot of window dressing. So we're going to see a lot of big funds and advisors and moving clients into the big tech that are leading the way, so that at the end of the year, investors get the report and they'll be like, oh, I own all these the best stocks that, did the best through the year. Meanwhile, they really just got into them at the end so that they look like and feel like they're doing all right. And if money's going to pile into the big leading stocks, which are driving this market higher, that's going to drive the market higher into the close of the year. So I think the dollar could be a little bit weaker. Gold is going to have that little bit of a bounce and drift higher. and stocks are going to rally as well. So there's a bullish case. I mean, for the end of the year, I think for gold still and equities.
All right. So interest rates, what are we looking at now, Chris?
Yeah, I mean, I always look at the bond market. I mean, as kind of the gauge of things. Obviously, we've had this huge bear market in bonds, rising rates. I do think rates are probably stalling out here. I don't think they're really going to go a whole lot higher, which could be one of the reasons why we have huge volume in the bond market. I think people are trying to pick a bottom, but there's no doubt we are still clearly in a downtrend. I hear a lot of chatter and a lot of news talking about this is one of the strongest rallies in the bond market in a very long time. But when you look at it in the grand scheme of things, we've seen big rallies over and over again, and they have all failed at this point. Even over here was a big one. So while I'm starting to feel like bond market may be bottoming, I don't try to pick a bottom. I would much rather let this kind of mature and give it time, meaning let bonds do whatever they're going to do. If they're going to rally way up here and then build a base and work themselves out, eventually they'll build a new launch pad. The downward momentum and the trends and the moving average will eventually flatline and start moving up. And, as we start to break from there, we'll definitely be in a new uptrend, and bond market will be in favor. But I'm not about trying to pick a bottom. That has failed terribly for many people over the last several years here. So I'd much rather just wait for the trend to shift, and then we catch the upside. Eventually it'll put in a top and start to break down, and then we would exit. It's about catching this middle section that is a low risk opportunity. So many people just love to try and time the markets and try to pick bottoms and try to exit at tops. Meanwhile, as we know, you can't truly time the market. And my whole philosophy is technical analysis, but it's not about timing the market. It's about following the market. Identify trends, confirm that a trend is strong enough in place that we want to take part of it, and then we move into it and we ride it up. And when it rolls over and starts to sell off, we get out once that trend changes. So there's a huge misconception with so many people in technical analysis. Oh, it's market timing. It's market timing. I would say it's just market following. And that's what I really like about it is we don't have to try to know what's going to happen. We don't have to guess and have the anxiety and fear of all that. We just have to let the market do its thing. We hop on the trends. We hop off when they're not working, and we go look for a new asset. And the bond market to me is going to be one of those, because I have a lot of subscribers constantly asking me, can we get in bonds? This feels like the bottom in bonds. So, I don't trade that way. I wait for time, trends to confirm, and then hop on board. It's about consistency in the trades, being able to move into big assets like this with a large amount of money and being confident and riding a trend versus hopping in when it's in these super volatile stages where you can lose a lot of money very quickly trying to get in during a bottom or top, because that's when the most volatility is. And it's the biggest guess. It's just a disaster in most cases.
All right. Yeah, people never learn. That's the problem with history, right?
Yeah, it repeats pretty frequently, it seems.
Yeah. Okay, oil. What are we looking at in oil?
Yeah, man, I don't have a whole lot of insight when it comes to oil. I think we had this big double top. We kind of draw a few lines on here. We had this double top phase, and then it broke down, and we've kind of hit this resistance area. We're now coming back down towards this lower end of this range. I feel like I do feel like we're going into a recession. I think things are going to get difficult. I think crude will eventually move even lower. 73 seems really cheap for crude overall, but knowing it can go negative, knowing it can go all the way down, I honestly think we could see crude back down in the 60s and 50s, maybe even the 40s by this time next year, depending on how things unfold. So overall, crude oil to me is trading in this big sideways range. Short-term wise, it's on a downtrend. Long-term wise, I feel like if we were to look at the big picture, I feel as though it is more or less in a major topping phase. And it's kind of something like this. We're going to eventually go into a big bout of selling or something like this. It's a big sell-off. This is a very, very critical line that crude could really dump out after that. So I'm not that bullish on the economy, not that bullish on crude. I think they're kind of related to each other. So it'll be interesting to see what crude does when it breaks down next year.
All right, next year sometime. So we'll be looking, we'll be watching it closely, looking for that fallout, which does could be perhaps inevitable. All right, and that is it for today. So technicaltraders.com, that's where you find Chris's work. What do you find there when you sign up, Chris?
Yeah, when you sign up, I do analysis just like you and I did. I cover it on a short-term, long-term point of view. We cover all kinds of different asset classes, including uranium, and we cover Bitcoin sometimes. So more or less, I provide the analysis for more or less swing trading, and I put on trades, and everybody just copies my trade signals. So I trade my own money with the signals, and more or less, you just copy what I do. So it's a trade alert newsletter, and you learn and can make money at the same time.
All right, Bitcoin's been on a tear. It's over 42,000 today. Shocker of all shockers. But I've been on a program. I buy it every Sunday, and I've sold off a few times over the past few months, and then rebuild the position gradually over time. And yeah, it's doing pretty darn good right now. I mean, it's up from 29 to 42. That's quite a move.
That's a huge move. Yeah. Are you a silver stacker? Do you accumulate physical too, or?
I've basically got my position, and I've held on to it for close to 20 years now. Right. I don't feel the need. Every now and then, if it dips below a certain number, I'll buy more bars, but basically I don't need any more. It's too hard to store the stuff.
It is. It is a pain. It does have a little cost to it, unless you want to risk keeping it at your house. But
no, we never risk that for sure.
No.
Never. So, all right. Hey, thetechnicaltraders.com. Got a question for Chris or myself, KL@kerrylutz.com. Make sure you go to the site, financialsurvivalnetwork.com. You'll find the links to Chris's site, and you can sign up for your free newsletter. Chris, we'll talk to you in a little while and see what these markets are doing.
Thanks, Kerry. Always a pleasure.